Joseph currently serves as Vice President of Wealth and Asset Management for MoneyBlock, where he is responsible for managing the development of the firm's wealth asset management platform. Prior to MoneyBlock, Joseph was a market maker at the Chicago Board of Options Exchange until 2001. He moved off the floor that year and joined the management teams of Options Express, where he utilized his CBOE experience to help build and grow OX's retail and full-service brokerage. Over the next 12 years, Joseph quickly grew his role from registered representative to the Senior Vice President of Education. He was directly responsible for the development of Option Express's education and media programs, as well as an integral member of the platform development team. Joseph is a frequent contributor to media outlets such as the Wall Street Journal, Business Week, Barron, CNBC, BNN, Bloomberg, and he's passionately delivering common sense solutions to complex issues. Joseph is a graduate of Marquette University and holds a Series 4, 7, and 63 license. So, Joe, are you here with us?
Ken, James, thanks, and I'm humbled by your my bio. It's longer than I probably should have had out there, so.
Not a problem. I'm actually really interested as I'm learning options as well, so I'm really interested in seeing what you're going to present to us today. So everyone, here's Joe, and Joe, take it away.
Thanks, James, and thank you. I just was listening to Josh's presentation, and I have to tell you, I think it's great. I love listening to other perspectives and other markets to trade and their expertise. You can always pick up something. And so, again, I appreciate James and your organization for having us on. And also I want to thank all of you. There's over 300 of you online, and it keeps growing. So today what I want to do is jump in. I'm going to give you a great perspective on using options, some of the basics, the core basic strategies. Now, some of you might say, oh, great, I'm going to go through this options thing. I've heard this a million times. I'm going to give you a set of guidelines, a pathway, a logic chain that you're going to be able to use where you're going to take the exercises that Josh was talking about with technical analysis and using other markets to kind of get a feel of what's going on with the overall market and use those tactics and techniques, but put them into a very concise logic chain. Now, we're also doing this in conjunction with our partners at TradeSpoon. So I need to thank them as well. Vlad Karpel is our partner at TradeSpoon, and so he is also, and his group are also involved with today's presentation. And so I just wanted to make sure that we acknowledge that, and I need to put up these disclaimers because, as James had said, I am also a registered representative, and, oops, sorry, I went a little too far ahead, and I do have to make sure that I also put up these presentation disclaimers about TradeSpoon and their affiliation, as well as the disclaimer about options involve risk may not be suitable for all investors. The characteristics and risk standardized options is available at theoptionsclearingcorp.com, or you can go to MoneyBlock or TradingBlock.com, and you can get that from our website. Any stock or option future symbol that I'm going to discuss today is for illustrative purposes only and should not portray a recommendation to buy, sell, or hold any particular security. So what's the agenda this morning? Well, in 45 minutes, some of you might feel like I just turned on a fire hose and you just got overwhelmed. So at any point in time, you can ask questions. We'll get to those. But I'm going to give you a unique perspective. I've been doing this for over a decade now, and actually these tactics, techniques, and discussion points, I've been spending a lot of time in the last couple of years dealing with institutional traders. You know, a proof is in the pudding, folks. I trade. That's what I do. I love it. I focus on it. A lot of people say that, but it's hard to see that proof's in the pudding, and that's how I am engaged with this, and that's how I focus on all of this. So we're going to talk about long calls, long puts, short calls, short puts, but this is going to be very different discussion. Now, this is the format that I'm going to take with these different discussions. I'm going to define the strategy. Then we're going to jump in and we're going to actually start with the setup. How do I get into this? Because a lot of times after you define it, and I'm going to tell you right now, my definitions are clean, concise, and they're very focused on the critical elements of this particular strategy. We're going to look at the underlying market as well as the stock that we're going to be looking at and develop that sentiment. We're going to do an estimated move analysis. We're going to use the power of the option. A lot of people try to use technical analysis for this. I find that difficult. It doesn't mean that there isn't merit in that. What it means is that the option price has something that technical analysis doesn't have, which is it prices in the potential move or the expected move of the underlying in that option price. That is something that all of you on this webinar should be focused on and utilizing, whether or not you trade derivatives or not. The P&L, we're going to go over some ideas. So we're going to look at the profit and loss characteristics, see how that moves. We're going to throw in probability, folks. Probability is a critical factor. Not only implied volatility, but probability are things that you're going to start hearing about more mainstream. It's starting to come up in the institutional world. As a matter of fact, every single tool that I'm seeing coming out by robo-advisors, which are these electronic advisors that actually allow you to structure portfolios, they're putting in probability of success, probability of profit, probability of touching. They're actually looking at all the tools and applications that the retail world has had for the last decade, and they're bubbling those up and utilizing those. And then we'll review the considerations and selection considerations. So for those of you that are not option traders, you're going to have to need a foundation. And I'm going to define what a call is, and then I'm going to give you the critical elements. Now, again, I said I'm going to keep it simple. Basically, a long call is a single leg strategy where you go in and you basically are saying, I want to have a specific price that I want to own potentially an underlying. That's the strike price, and I'm going to pay a price for that. All right? So you'll see from the graph I have defined risk, and I have unlimited reward to the expiration of that particular option. So it gives an investor a lower cost entry into what they would say is a very bullish sentiment. So what are the critical elements? Market outlook. You got to be bullish, folks. Not kind of bullish, not barely bullish when you're looking at just a single leg long call. You have to be very bullish. This is the pitfall that almost all of you get into when you trade options. You look at them and go, oh, I only have to put up a couple $100, and if it gets to that level or blows through it, I'm going to make huge returns. Folks, the probability of those options that you buy that are really cheap, of them being actually profitable, is probably less than 20%. That's why you're losing all the time. So set your market outlooks, and if you're very bullish, then you could be looking at long speculative single leg calls. The other thing is that we may be using limited risk capital, meaning that your account size isn't that big. And anytime you hear the term debit, that's your riskier trade. So in other words, whatever you pay for an option, and you say, okay, my debit is $1, that is my risk. And that fulfills what I want, which is limited risk. Now my potential reward, well, that's theoretically unlimited. I say that it is an institutional kind of thing, but really it's until the expiration of the option. So always manage your profits. That is something that we talk about in future events, but it's definitely something that you need to have planned out before you jump in. Now, I am not going to jump to an example yet. The reason why is, how do I even know what's going on with the market? Now, you can take the techniques and tactics that you're going to hear from a variety of different speakers, and a lot of techniques out there by other market insiders and teachers. I take a very simple, straightforward approach of using the various tools and applications to come up with my ideas and then execute them. First and foremost is that any trader that's worth their salt, or anybody that's been in this business for any extended period of time, you will hear them, hey, where are the SPOOs? Where's the Dow Jones? Where's the Russell 2000? In other words, the RUT, the NAS, the SPOOs, the S&P 500. You have to, or the Dow Jones, you have to pick an index. That helps you define a perspective and opinion on the overall market. And you can use the different techniques, like Josh was using Fibonacci's. There could be people that use simple moving averages. You could draw trend lines, right? Just take 2 points. You got 2 trend lines. Boom, you got 2 points, you got a trend line. In this case, I'm looking at the trend of the overall market, the Dow Jones. And I see that it's been trending up nicely, basically over the last year. Now, with that being said, once I have a firm understanding of what's been happening in the marketplace right now, and I feel that there's some conviction of the bullish nature, I'm going to look at stocks that are made up in that index. Because if I have that confidence that the index is going up and that there's bullish sentiment, then I'm going to look at a particular underlying. This particular underlying is made up in the Dow Jones. And I'm going to look at this. Again, I'm not a super technician, but I'll draw a trend line. Boom, 2 points. That's a trend line. It's been trending up basically at the same pace or level as the underlying overall market. And so I have some confidence, first of all, about my bullishness of the overall market. I have confidence of my bullishness on the underlying market that I'm looking at, specifically this stock. Now, folks, you can put simple moving averages. You can use lower studies. You can use Fibonacci extensions and retracements, whatever you want. Study those. But I'm just giving you a basic, hey, I'm looking at a picture. I want to get an idea of sentiment. Now, once I get that idea, it's really hard just from looking at a picture to actually go out and forecast because you're looking at past price history. So what I do right away, and typically this is an exercise, what I'm about to do, that's good on the moment that I'm looking at these prices, right? I have that picture of the market, right? I got an idea of the trend. Let's take a look at the options now, and this is how you can actually improve your trading, folks, quite a bit, right? Let's look at the options and see what they're expecting for potential move of the underlying, right? This is really useful for events like I'm about to enter into a trade and I want to get a perspective of what is being priced in for potential movement, or at expiration, or before a binary event like earnings. So let's do this back of the napkin math. This is real quick, right? I'm going to take a front month straddle. Oh boy, more vernacular. Basically what a straddle is just the same strike call and put, right? So in this case it's the 57.5 call and put. I'm going to take the front month strangle. That's the first strike out of the money option for the puts and for the calls. All right? That's the strangle. I take the offers for all four of these. That adds up to 239. I divide it by 2. That's giving me an estimated move at the time I'm pricing this out of $1.20. So that's basically telling me that this total has about a 50% probability of either moving up or down by that amount. Ladies and gentlemen, this is a dynamic calculation, and it is not directionally biased, okay? This is just telling you that's what the marketplace is pricing in for potential movement in the underlying. Now, some of you might say, oh, gosh, you know what? I want something that goes over a very specific time frame. 1 day, 7 days, and 30 days. Well, this is an expected move over these specified time frames. We just basically take the stock price times the implied volatility and divide it by the square root of time, right? And how I came up with these particular denominators, well, for 1 day, there's 256 days in a trading year, right? There's 256 trading days in a year. So I take the square root of that. That gives me 15.87 and so forth. Now, based on this current volatility in the marketplace, this gives you the amount that is already priced into the options that the stock might move up or down within one standard deviation. That means, folks, if you're looking at that curve, and I'll only do this pathetic drawing once. If you remember that bell-shaped curve, right, basically this calculation right here is locking in this area right here. 68% of the price action right there, and that is horrible. Horrible drawing. I won't do that anymore. But 68% of the price action is going to be locked in based on this time frame, right, for that calculation. So let's actually break that down. Let's show you with an actual example. Stock's trading at 56.68. The IV right now is at 1687. This is an average. At Trading Block or Money Block, you can go on our volatility charts. We have a table right below the vol chart. You can get both the current, high, and low, as well as the average for any one of these, for this vol range. You can also get the historic and stock price. We'll go over that in a minute. So taking a look, just taking this quick calculation, you take the stock price, multiply it times the implied volatility. Remember, that is a decimal, right? This is a percentage, so the decimal point right here. And you divide that by 15.87. That's telling me that JPM right now is the options marketplace is pricing in the potential for the stock to move either up or down, or basically in a range of 60 cents. 7 days, 133, 30 days, 276. Folks, this is a dynamic calculation, but this is also a forward-looking calculation. This really helps you understand why over the years when you sit through these webinars, and there are people that say, well, if you buy these out-of-the-money options, you don't really have a lot of opportunity to be potentially successful. Why is that? Well, because the marketplace may not even be pricing in the potential for this to move to a point where you'd even be at a break-even, especially if, again, if you're long options, and specifically in this case we're looking at call options. If I bought the $60 calls, and the stock over the next 30 days slowly grinds up and it goes up basically about $3, those calls are still out of the money. And most of the time, you don't understand why the stock moved in your direction, but you look at your option position and you lost money. Well, guess what? Now you know why. Two reasons. One is time was working against you, and you didn't do anything to offset that. And the other thing was that the options marketplace wasn't even pricing in the potential for that to potentially get to that level or through it. So that's why this really helps you in potentially when you're initially setting up your strike selection. All right. Now I mentioned implied volatility, and how I use implied volatility, folks, is pretty straightforward but very powerful. And this helps me assess, first of all, if I am bullish and volatility is high, moderate, or low, this will help me assess what strategy I should be looking at. So, for example, I'm looking at this and I said, well, you know what, the vol was low here, it's intermediate here. This actually should be, this should be right here, and it was high here, it spiked up. But today, right in this range, I'm looking at it and I said, you know what, the vol is trading here right around that 16 level. The low was probably down here in the 12 level. So there's 4 points between 12 and 16, which basically is telling me that the IV rank is at 33%. Now you're going to hear that term more and more come up, IV percent rank. That's just telling you, based on the 52-week low in implied volatility, the current volatility is 33% higher than that low. The reason why I point this out is because when this percent rank starts to get above 50%, there's two things that I got to look for. One is, why is it at a level that's 50% or higher? In other words, why is there a heightened sense of potential movement, either up or down? Because as you can see here, you have implied volatility up here close to the highs, right at 25. And you see that the market was at a low and then it took off to the upside. So just because implied volatility spikes up does not mean that the market's going to go down. It just means that there's a heightened expectation of potential movement. So first and foremost, when it gets north, that IV percent rank gets north of 50%, that's when you are going to look at why. Once you've determined why, then what you do is you say, if I'm going to do a bullish strategy, and volatility is starting to get on the upper end of that curve, is there a strategy that I should be implementing? Is long calls the best strategy? Is maybe a bull call spread or a vertical the right strategy? Butterflies, whatever it is, you're going to then be able to determine what's the appropriate strategy that matches your sentiment on the market and your sentiment as far as volatility is concerned. In this case, with where vol is, and stock's trading at 56.68, I have a forecast that the stock could potentially go up 3%. Now, you could use some of the techniques from the previous previous discussion to kind of get an idea of, first of all, where support and resistance starts to come in using Fibonacci's. That's actually something that I've used in the past, and I picked up this morning when I was listening to that particular presentation. That might be an interesting thing to utilize. But for me, all I did was take the estimated move over the next 30 days, and I used that amount that basically gave me a barometer. And then you could use those overlays of the extensions or the retracements, depending upon bullish or bearishness and your positioning. And you could actually say, well, you know what, that's at the 38% or the 61% or the 78%, whatever it is, right? I'm just trying to throw that out there for you. But the point being is that this case, I'm doing the $45 call, and I'm going to buy that for $11.70. That means $1,170 per contract in real terms. Now, folks, you're going to say, whoa, that's a lot of money. With the stock at 56, first of all, I'm putting out $1,100 bucks. Second of all, I'm doing something that's deep in the money. And the reason why is because while I was bullish, and there are, in a future discussion, we can talk about how we can use verticals, and I'll actually show you on the grid how we could use this. But the bottom line is I'm in here to make money. I'm not in here to hit home runs, okay? And I needed a strategy that's going to fit my directional bias as well as what Vol's telling me. And Vol is telling me right now that while it is increasing, in other words, it's in that IB rank of 33%, the problem is that it's not, it's still at a level where it's relatively inexpensive. And if the market just grinds up and I buy an out-of-the-money option with really only about a 3% upside forecast, I need to be conservative. But more importantly, I also need to fit limited risk. I want to have unlimited return up until the expiration of that option. The other thing is, too, when I buy options, I'm typically going to buy options, when I'm straight out buying options, I'm typically going to buy options with time. Why? Because I need time to be right. Unless I'm going to spread this off, when I buy single leg options, I'm probably looking in the time frame of right around that 60 to 90 days is that time frame, which means that there are a lot of other things that I could do if the market between the expiration of what I bought and when I enter the position, I could sit there and buy these options today, and then maybe sometime next week, because the market gets a little bit choppy or it starts to trend down a little bit, I could sell some front month premium. In other words, calendar or diagonal it off. Folks, I'm putting this out there because I want to make sure you understand this is versatile. But also, most importantly, as I've discussed, we like to use probability. What I mean by that is that I want to make sure that whatever strategy I am implementing, it's going to have a higher probability than either just going long or short and underlying. So in this case, I'm bullish, and typically when you're bullish, the first thing you would think of is buying stock. Well, I didn't want to put out $5,600 to purchase stock. So I wanted to put out a small amount of capital, buying an option, check. The other thing was that I looked at Vol was cheap, so I'm not paying a huge premium, or in other words, there's not a huge expectation of a violent set of moves, either up or down. Okay, great, check. Third is that I want to have a higher probability of profit than just buying stock outright. This gives me a 61% probability of any profit, right, going into that expiration cycle. So this totally fits the bill for me. And that's how I use probability of profit. I want something in that 60, 70, 80% level when I'm looking at a strategy. And that's hard to come by when you're thinking about buying single leg options. It's a very hard strategy to implement sometimes. So let's just cap this one up and then go on to the other three strategies. Again, determine your sentiment in the market, whether you're bullish or bearish. Use a benchmark, then look at your underlying. Once you've determined that, then look at the option pricing. That gives you a range that you could potentially start looking at in strikes. Okay? And then finally, look at vol. And you look at implied volatility because that's the component that not only can give you that forward looking by the pricing, you remember when we priced out the estimated move, but it also helps you in understanding, right, what the expectation of potential movement is in the underlying. It's a nice little check and a nice little tool that really helps you understand when vol is low and I'm bullish, and let's say I'm very bullish, I could buy calls. Now, if you're kind of bullish, if you're sort of bullish, mildly bullish, instead of just buying those calls, and again, I bought in the money calls for my example, but you could have bought the at the money calls or even slightly in the money calls and sell an out of the money call against it. You could sell put spreads. You could do in the money call flies. You can buy out of the money call calendars. You can see from this grid as your expertise and knowledge starts to increase, or if you originally buy a call and then all of a sudden you see that the market just kind of sits there in a range, you could sell an out of the money call against you. Now, yes, that does cap your potential profit potential, but it also offsets your risk. And that's for a future discussion. As a matter of fact, we have a lot of videos and so forth on our site at Trading Block. And as a matter of fact, if you go to YouTube, Trading Block TV, we actually have a huge YouTube station with a lot of these discussions. All right, let's go into buying puts. Again, Simple, straightforward logic. Buying a put, I'm bearish. I want to take advantage of potentially having downside move. And so how can I do that without having fixed risk? Buying puts. Market outlook, I'm very bearish. I'm not very bearish. I'm not mildly bearish. I also want to have limited risk. And my max risk, again, when you hear the term debit, that just means that the debit you pay or the price you pay is your risk. All right, my maximum reward, well, if the stock goes to zero, it's reward. That's my maximum reward. At the end of the day, it's basically until the expiration of the option, I will participate on the downside, but with limited risk. All right. So what do? Well, I look at a benchmark. Again, I'm looking at the Dow. And the Dow's been trending up, but we saw right here it pulled back. Now with it pulling back, bouncing here, it came off that trend line. But if it goes back and challenges that trend line and breaks, we could see that what was support is now resistance. So I look at an underlying that's actually in the Dow, and what it's been doing is actually trending against what the market's been doing. So it's been in a bearish phase, even though the market's been in a bullish phase. So your interpretation is that if it challenges this and comes off and the market re-challenges and breaks, this could get really bearish. So that's my underlying sentiment. What are they telling me? And again, I'm going to move a little bit faster here because we took some time to discuss these tactics, right? I take the straddle strangle markets, I add them up, divide by 2. This gives me the 50% probability of moving up or down by this amount, 40 cents. I can do the more dynamic calculation as well, right? And this, again, is a quick check for me to go in and basically say, all right, within a 1 standard deviation move, either up or down, right? This is what they're pricing in. This is a 1 standard deviation move based on these time frames, okay? And this helps me with strike selection. And again, this is very powerful stuff. I look at an implied vol chart, so I'm looking specifically at this green line that's tagged out against the stock price and historic volatility. And historic volatility is just looking at the past price history over specified time for stock and then plotting it on a line. And I look to see if vol is high, mod, low. Why? Some people go, well, if it's high, I'm selling it. Well, I don't agree with that. That actually gets you in more trouble than it's worth. You don't just go out and sell it. First of all, you figure out why it's high. What is the event, whether it's earnings, whether it's maybe a drug trial that's about to come through the phase 3. It could be that there's a merger or acquisition that potentially is on the horizon. In other words, there's some sort of binary event that has increased the expectation of potential violent moves. Not this grinding down or not this grinding up, right? It's that snap move right there. And once this big move happens, what happens to vol? It comes off. So the bottom line is that I look for high, moderate, or low, and I then determine the implied volatility rank, okay? In this case, with stock rating at 22, I'm forecasting that the stock could potentially go down about 4.5%. How did I come up with that, folks? I just took the estimated move for the 30 days, and I divided that by 22. All right, there was no rocket science behind that. And again, I would definitely, if you need, there are other techniques and tactics. The other thing that I want to throw out there, I'm going to reiterate this for the next two positions. Your sizing is critical, right? Most people, the biggest downfall right now is you buy 96 cheap options, right? I didn't want to put this out there as the guy post, but the point being is, folks, you buy these cheap options, you buy a dump load of them because it's cheaper than buying the stock or selling the stock outright, but that's a mistake. Never use more than 1.5 to 3% of the buying power available at the time of the trade or your percentage of your portfolio. 1.5 to 3% is my guideline. All right, so I looked at buying those $22 puts, paying 31 cents. That means I have $31 per contract, right? So I have limited risk. That's my debit, right? 31 cents. I have that reward until expiration. In other words, if the stock goes to zero, that's my maximum reward. So it fits my so far, my checklist. I look at the probability of profit. And the one thing that I see, folks, is that even though I'm paying only 31 cents for the ability to participate if the market's going to go down, the problem is that my probability of any profit is 33%. And that's lower than selling stock. That's when I immediately go in, and I just want to do a little learning moment here. That's when I immediately go in and say, well, how can I improve my probability of profit, or in other words, my risk reward? That's when you go in and start looking at alternative strategies where your bullishness or your bearishness in this case is a little bit tempered because you're not seeing the probability of profit. Well, spread it off. That just increased my probability by 10%. So in other words, if I buy the $22 puts, I could sell the $21 puts or the $20 puts and reduce that capital risk that I have. That increases my probability of any profit, and it improves my risk reward. So in this case, right, I was bearish. Implied volatility was relatively low, so I looked at buying puts. And again, I'm trying to look for a fixed risk way to attempting to profit from a declining underlying market. Now, more importantly, once I buy those puts, I could look at something like selling a put against it, right? In other words, buying that put and then selling it out of the money put against it. As you saw from the probability of profit component, that increased my probability of profit by 10%, okay? All right, let's go to the bearish strategies. And again, I know I got to keep honest with time, so I will definitely keep an eye on that. Selling naked short calls. In the options world, this is the riskiest of all strategies. Why? Well, when stocks can go for an infinite amount of time and price points. In other words, you have unlimited risk. All right? Now, statistically, we could set up great strategies with selling naked calls. In other words, selling way out of the money calls. But there are dangers with this, and with this one, it's that unlimited that risk potential. All right? And you sell naked calls when you are extremely bearish. Okay? All right? And your maximum risk is theoretically unlimited. And the reason why we put that out there is because at expiration of this option, you're then just short stock, right? And that stock could keep going up, 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 and up, right? And the market will stay irrational longer than you will stay solvent, right? You've heard that many times before. Your maximum reward is going to be limited to the credit you receive, folks. The credit you receive. So anytime that you hear credit, that is your maximum profit, but that is not your maximum risk. All right, let's take a look at the market. And again, we're looking at the overall market. And you can see that the overall market kind of got capped out right here, pulled back, broke that short-term trend line, right? And what was support is now resistance. All right, and again, you could use tactics and techniques that you're learning, but I'm just using some basic take 2 points, draw a line. And the underlying market, the stock that I'm looking at, has been trending down. And the market was going up, and this was still trending down, and now it's continuing to pull back and actually might be picking up. So what do I do? Once I have a perspective on the market, folks, straddle, strangle. Now this is good at the moment that you're looking at this particular idea as you're scrolling down. What's the market telling me? This is back of the napkin. This is a dynamic calculation. It gives you a 50% probability of moving up or down by this amount, right? The straddle, strangle, divide by 2. This is something so you quickly, if you don't have a tool or application in front of you, you can do this math really quick. That's why I show it. And again, if you want to dig deeper, you can actually go in and you can say, okay, I'm on a 1-day, a 7-day, or a 30-day. And you can see what the market's pricing in there. And again, we look at a view of where vol is. in that range, probably in that moderate range, but still well off the lows. As a matter of fact, this would be in the 100th percentile rank. So there is a real heightened expectation of potential movement. What my potential strategies could be, right? That helps me understand that there is some sort of binary event out there. There is some sort of expectation for whatever reason of big potential violent moves. Now, does it have to happen that way? No, right? You can see that clearly the stock was just grinding up here, that red line, even though vol was all over the place. So you have to keep that into perspective. In this case, I'm looking at stock at 185. I'm forecasting that the stock could potentially drop 2% by the expiration of this option. So I'm going to look at the 195 in this. I'm selling the 195 calls for $1. All right, that's $10 out of the money. Now, typically, I just want to give you another rule of thumb that I utilize when I'm selling options. I will not sell an option unless it is at least one standard deviation out of the money. One standard deviation, if you don't have the standard deviation calculations on your platform, typically a nice rule of thumb is that you're going to sell an option typically that will have a 20 delta or less. It's usually around a 20 delta where you'll get that one standard deviation level. That basically means that if you're selling a 20 delta option, that means that you have an 80% probability that that option will go out worthless at expiration. All right? And again, when I'm selling naked options, specifically naked short calls, my sentiment is I'm very bearish, right, when I'm selling them naked. Right? I have nothing offsetting it, and I understand that my risk is potentially greater than the reward of doing another the reward that I'm receiving with the credit. Now again, probability of any profit, 80% on selling this call. So then versus selling stock outright, which only has a 45% of showing any probability of profit. Okay, so selling that further out of the money option, even though I'm getting less premium, right, I am getting an increased probability of potential success, folks. And that is the important thing. When you put out a bunch of risk capital on a very directionally biased type of strategy, and you're really close to the marketplace, I'm telling you, you're going to get burned more times than not. So when you're looking at selling naked short calls, right, you need to be extremely bearish. You need to understand that your risk is unlimited, that your reward is limited to the credit you receive. And the other thing that I want to point out is two things. I've already mentioned the one standard deviation out. The other thing, folks, is that when you are selling naked calls, your time frame should be 45 days or less. Bare minimum, 45 days or less at one standard deviation. Those two rules right there, one standard deviation and 45 days or less, will keep you out of a lot of trouble. Okay? Now let's talk about, and you know, one other thing that I want to point out. Now that you understand the basis of selling calls, the sentiment, setting it up, you can also say, well, you know what? I don't want to sell a naked call, but how do I participate in this? You could do a spread. Like I said, these are versatile types of strategies. And if vol's high, you're bearish, and you don't have an account that either you could be naked short options or you just don't have the risk tolerance for it, take a look at doing a call credit spread or a bear call spread, right? There are other strategies when you have these sentiments that may fit your risk tolerance and objectives. And like I said, if you go to Trading Block TV, you can check out all of our videos on this, or you go to tradingblock.com in our Learning Center. Now, selling puts, and all these strategies, by the way, I'm just telling you, I've been doing this for a decade now in front of retail. In the last 6 months, I have been talking to more institutional or money managers about incorporating the options product, whether it's selling puts to get into or offset. In other words, they have to reset their position balance in their portfolios, and they don't want to buy stock right now. I tell them sell a certain amount of puts that will get you in, cost average you in, you get to take that premium in, and it's lowering your cost basis of entry. Selling calls against stocks because the IV percentile is in that 50, 60, 100% level, and it's giving them, it's actually balancing their portfolio because it might have extended out of balance because it had a nice run up. Folks, I'm telling you, I've been having these discussions, and it's not with reps that have $100,000 or $200,000 that they're working. It's billions, and I am not kidding when I say that. So these particular these strategies, these core strategies, they're implementing them within their portfolios, and it's garnering a ton of momentum. That is the fastest growing segment, the use of options in the portfolio as a portfolio tool for for managers. All right, so when you sell puts, what's your market outlook? I'm bearish. I mean bullish. I'm selling these puts, but when I sell a naked put, folks, I'm okay with owning the stock. I want to own the stock. If you don't want to own stock, there are better strategies that you can do that incorporate selling puts, but not doing it naked. But if you want to get into stocks that you like, but you want to get into them at a lower cost basis, you can look at selling puts, right? It's similar to stock ownership because if the underlying starts to drop, that put strike price gets deeper in the money. And as the stock keeps going down, you're going to lose money on that short put. So the credit you receive offsets your entry price. So if I sell the 30, and then we'll get into an example, okay? So I won't go through that. But that premium offsets your actual break-even point, right, if the market keeps going down. But at the end of the day, if you want to own stock, selling puts is a great way to get into stocks, okay? Again, look at the overall market. Look at a stock that's been in there. Okay, and thank you, James. I'm almost at the end. I appreciate it.
Okay, Joe, I just wanted to let you know, not to interrupt, but we are running a little bit long now, so I can give you a couple of more minutes, but just be mindful of the time here.
You got it. I got it, bud. Thanks a lot. I appreciate it. Straddle strangle. You do your calculation. Take a look at IV vol, and as a matter of fact, you see the IV rank right now is at the 43rd percentile, right? You see that it's getting to the 50th percentile. I might want to own Microsoft. I don't want to own it at 38, but I would love to own it at 36, and actually this gets me in at 35.10. So when you sell a put at 35.10, you're going to own it. If the stock is at 36 or lower, I'm going to own it, but let's say it's at 36 or 35.50. I own it at 36.10. I earn it at a discount. The probability of any profit, 58%, which is better than the probability of buying stock and having any profit, okay? And at the end of the day, when I look at this and I wrap all this up, when I see that vol is high, when vol is high, I can sell puts. If vol is moderate or high, but I don't want to own the stock, you can do a bull put spread where you sell the at-the-money put and buy it down to the money put, right? And again, I do not sell any options, specifically naked options, unless they are at least one standard deviation out of the money. So you're looking at 20 deltas or less, right? And I don't sell them outside of 45 days. So I want it to be 45 days or less. All right, folks. Well, that is my presentation. As James just said, we're running over a little bit. This is how you can get a hold of me. If you want to have a copy of this presentation, if you want to learn more about the opportunities at Trading Block and Money Block, if you're looking for an advisor, I am an advisor as well, and you're seeking out someone that can give you advice, that can help you through this process, whether it's to manage a portfolio or to walk you through. We have over 70 advisors. If you're looking for a great website to go and trade for yourself, Trading Block, where self-directors can go, self-directed investors can go. Now, also, I think, James, I believe that there was a website that Vlad wanted to put out for TradeSpoon, but TradeSpoon is having an offer. I can't talk to it because I am not a representative of TradeSpoon, but they are a valued partner, and they are also one of the participants in this weekend's discussion. They were a part of it. So you can always go to tradespoon.com/deal. I know Vlad and Tradespoon, they have a live help there. They can answer anything as far as the offer that they want for today's participants of webinar. This is where you can get picks from Tradespoon, and you can talk to them about getting more information on that as well. If you're interested, they give stock and option picks, and as always, they are there to help and answer any questions. So info@tradespoon.com, or go to the tradespoon.com/deal, and you can get more information on their deal. So with that being said, I know, James, that we're going over, so I probably don't have time to look at the questions, but if you guys have any questions, you're welcome tomorrow. Appreciate it. Hopefully the slides worked well. If anybody wants a copy of the slides, support@tradingblock.com, support@moneyblock.com. That comes directly to me. Any questions, considerations, post the webinar. You're always welcome to please. And thank you, James, for putting out there. Vlad, thanks you. Valor, thank you, guys. This is such nice.
Not a problem, Joe. Thank you for your time today. If everyone could confirm that you did get the 2 email addresses that I sent out, as well as the tradespoon.com/deal that I sent out. I just want to make sure that everyone did get that. So Tamara, thank you. Joseph, Tamer, thank you. Valerie, Norman, Christina, Michael, wonderful, everybody. Well, I will resend out those links. If you didn't, it says Elizabeth didn't, but I will make sure that I resend those out. And Joe, I want to thank you as well for your time today in bringing us some insightful information on trading options. I certainly learned a lot. I hope everyone else did as well.
Hey, thanks for the opportunity, James. Have a great weekend, guys, and get ready for next week. It's going to be a fun week, new trading week month. So have a great week, and we look forward to seeing you online.